let's discuss the concept of kiddie tax rules, where it came about, how it works in action. So in general, if you're a high earner, most high earners would rather run the income through their kids, in the sense that kids pay little to no taxes compared to parents who could pay like 37%. So if you could gift your child securities, which is up to $19,000 is the gift rule, right? Then it comes off your unified gift estate and gift tax credit, right? Of like I think it's like $15 million in 2026. So naturally, parents would like to run the income through their kids. So the IRS is savvy to that. So they created certain mechanisms where you can't abuse the system too badly, right? So let's say if you were to gift your child securities that produce income, maybe in a UTMA, UGMA, right? And this is how it works. If we're talking about exclusively unearned income, that means income that the child did not actually earn. So it's income from interest, dividends, that kind of stuff, right? Capital gains. This is how it works. So the first $1,350 is not going to be taxed at all. The next $1,350 is going to be taxed at the child's tax rate, and then which would be 10%, and then the remainder would be taxed at the highest parent's marginal tax rate. So let's say if the child made $10,000 in interest and dividends, then the first $1,350 no tax, the next $1,350 at 10%, right? So whatever, $135, and then the remaining $7,300. Let's say if the parents are in the 37% marginal tax bracket, highest one, the parents are going to get hit with 37% at times 7,300, right? That's an example of one that's where it's just unearned income. Now, if we throw earned income into the mix, it's going to get a little bit trickier, right? So let's say a child has both earned and unearned income. So let's say 10,000 earned, 10,000 unearned. So if we go back to the previous example, we find out that the parents would be on the hook for $7,300 of that income. So we're going to put that to the side. Now, the rules for earned income are as such. So whatever the child's income is plus $450 up to the maximum standard deduction of $16,100 in 2026, right? And obviously the rules change every year. In this case, that's under $16,100, so $10,000 plus 450 is $10,450. So that's going to be the deduction for the child, right? So now we go back to the entire pie, right? So that $10,000 is not going to be taxed. Now, of the remaining amount, we address that whatever $7,300 is going to be taxed at the parent's tax rate. Then we're going to have $450 is going to be at the not taxed at all, right? And then the remainder, so $7,300 plus $450, what is that? $7,750. So the remainder of that, which would be $250 or something like that, that would be taxed at the child's tax rate of 10%. So it could be quite complicated. So you can always rewatch to kind of follow on my example. But please like and subscribe, and hope you enjoy the rest of your day. Thanks.